Now let's examine some more charts applying the clear foundations of resistance and support identification, along with additional case-specific techniques such as using the IPO price. Spotify stock provides a good example for that, since in this situation it has just listed on the stock market. IPO stands for Initial Public Offering, and that is when a stock begins trading on the stock market. The IPO price is the first price a stock begins trading at once it enters the market. In this case, for Spotify stock, it is 165.90. 149.01, which could be rounded to 149, is an important price also because it is the closing price on Spotify's first day of trading. It is common and natural to see trading centering around these two prices for a short time after the IPO. Unlike other markets that won't constantly have new assets being listed, the stock market constantly has new stocks entering the market. So we can see a situation where accurate support and resistance are easily identified without necessarily using the classic techniques discussed in the previous section. And speaking of the last section, principles from over a year later, 149.01 to be extra precise, still has great influence on the market as it now begins resisting rising price. This is called role reversal and can be considered another core characteristic of identifying valid support and resistance. In this case, the prior support now becomes a resisting range. It could also be the other way around, where a resistance becomes a support, such as with the IPO price near the beginning here. And later on, roles can reverse when it returns back to resistance, such as in this case. And that adds to the further validation of certain areas being more contentious among buyers and sellers. Despite some sizable upswings, Spotify still has difficulty clearing above the 149 level, but at the same time we can also identify a lower support range from roughly the 120 to the 105 level. Later, when price sharply declines, there is support, as would be expected, at the 120 area, which produces a series of upswings. This drop was due to a head and shoulders pattern, and the upswings were further validation of the 120 area, especially as it was a gap fill area. Knowing about such chart patterns isn't entirely necessary, even if they weren't identified. The core principles of identifying support and resistance through the previous swing points was more than adequate in identifying these highly influential price ranges. Adding slightly more advanced techniques such as chart patterns just adds another layer of validity to the chart and the support and resistance identified with the basic methods. Gaps in the daily time frame are also more common in the stock market because of such regular events like earnings reports, which are a major catalyst of volume and price action. And with the upward reversal around 120, we still see those characteristics discussed earlier. Especially when there is strong volume, a strong support area can still temporarily be penetrated, and this proves that looking at one specific price level isn't always the best idea, but rather to have the price level be the center of a wider support range. Just like chart patterns, it is not entirely necessary to have extensive knowledge about candle charting for our discussion here, but it is useful to understand the price action here, where the market does temporarily go below the 120 level, but overall, during the swing point, or rather swing area here, the market tends to close above the 120.50 level to be precise. Further bearish weakness is evidenced by the declining amount of bearish red volume and price action, along with the increasing and consistently high amounts of green bullish volume and price action. And we can see signs of hesitation and delay in the market around April, where there is relatively low activity as seen with the more narrow price action and overall declining volume. It isn't completely necessary to fully understand the actions of buyers and sellers and the reasoning for doing what they did during this time span. Foundational technical analysis paints a very clear picture that is more than adequate, illustrating the declining selling pressure and increasing neutral to bullish sentiment in the market. It is indeed a very aggressive uptrend, and it is able to easily pass the initial 165.90 to 149.01 range, which does still delay the market slightly. As would be expected, there was resistance at the 190s near the previous all-time high resistance range. At first glance, it was likely to be another triple top reversal. However, yet another strong surge of bullish price action and volume was more than adequate to continue the aggressive uptrend to new record highs. Going back and focusing on the triple top reveals it to be a highly valid resistance, not only because of the aforementioned triple top, but there was also increasing volume near the swing points, and that is a good classic characteristic, along with the alignment of more precise levels around opening and closing prices. In fact, going to a line chart with each dot representing a closing price reveals the 195 level to be an even more accurate center for the resistance range. Again, temporary movement over the resistance, whether it's centered around 196.30 or exactly 195, doesn't matter that much and is actually quite acceptable since there was high volume at these downswing points. Looking at the closing prices and the tendency to move back below exactly 195 is showing that in addition to a nice round number for a neater chart, 195 was the more accurate level to center the resistance range around. In the end, it is a marginal difference, and 196.30 was still an adequate and accurate level to center the resistance range around, and it also demonstrates the idea that resistance and support can be thought of as ranges and not to narrow them down to exact price levels. At the same time, it shows technical analysis has some flexibility in allowing for variation and even a small margin of error when identifying support and resistance ranges. Remember, the market is dynamic and there won't always be a fixed level down to the decimal point of exact support and resistance at any given point in time. Simply following the core ideas, such as running through multiple and recent swing points of large reversals, is more than adequate in identifying approximate areas of interest for the majority of market participants.